Hello, everybody. I hope you're all well. My name is Mark. I'm also the stock market jobber. I'm here to teach people like yourself about how trading works and how Wall Street works. I spent, about 20 years in the institutional trading world. I traded directly for two of the best money managers in history, Mary Gabelli and Steve Cohen. I was the head of trading at three different money managers where I oversaw all kinds of strategies, everything from deep value to high frequency. We offered a lot of different hedge funds. I was a market maker. So I've been around the block. So what I'm going to do is a little improvisation here. All right, we're just going to look at some different charts on gold. And the reason why John Coltrane mentioned fractals is because when we look at charts, we see the same things playing out, the same dynamics, regardless of the time frame. In other words, this chart here is going back to May, all right, last year. I mean, if this wasn't labeled, this could be a day chart, it could be a 5 year chart. You wouldn't know. But the same things play out, and that's because charts are graphical illustrations of human behavior or human psychology. And we have different humans with different time frames in the investment world, so this is why we see the same principles playing out. For example, we can see here that, let me just find my pen. We can see here this is what we call a support level. All right. When a market is moving lower, it's because there's not enough demand to fill all of the supply, or there's not enough buy orders to absorb all of the sell orders. So investors who are selling are forced to offer their shares out at a discount, and this forces a downtrend. When we get to a support level, all of a sudden the tide turns. There are enough buyers or enough buy orders or enough demand to take in all of the supply or sell orders. Now, a lot of times when we get to a support level, we bounce. Why is that? Well, it's because some of the investors get the sense that there are other buyers around. That's why the price stopped going lower. So this level here is about 18, call it 1830. And someone might say, you know what? I don't want to miss this. So I'm going to pay a little bit higher. I'm going to be willing to pay 1835. Someone else says, oh, I don't want to miss it either. I'm going to pay a little bit higher, and so forth and so on. And it causes this kind of snowballing effect. And we can see here, we got the supporting best. Now, when the support breaks, this means we get below it. It tells us that the investors who created the support with their buy orders have left the market. So a lot of times when a support level breaks, we get a pretty rapid move lower. And that's like what happened here. Because anytime you take demand out of a market, it sets the stage for supply to push it lower. It's just your basic economics 101. Now, we get back up here, and what do we have? A resistance level. Now, how is it that the level that was support becomes resistance? When a market's going higher, it's because there's not enough supply or sell orders to fill all of the demand or buy orders. So the buyers are forced to pay a higher price or bid a premium, and that forces an uptrend. Levels that were support can become resistance. This is a very common thing because of buyer's remorse. There's a lot of investors who bought back here who now regret doing so when the price went lower, and they tell themselves they want to sell. But here's the thing, they don't want to lose any money. So they tell themselves, I'm going to sell if it gets back up to my buying price. So if we have enough remorseful buyers placing sell orders at the level that was support, the level converts into resistance. So we see this all the time. Here we have the opposite. A level that was resistance becomes support. A level that was resistance becomes support. This is seller's remorse. People sold, and when the price went higher, a lot of the investors who sold regret doing so, and they tell themselves they're going to buy their gold back or their shares or whatever it is that they're trading. And if there's enough remorseful sellers placing buy orders at their selling price, the level that was resistance converts into support. So when we look at a chart, we are looking at human psychology. Down here we have another support level, and sometimes a level that support can retain its importance for a while. Here we have resistance. Sometimes a level that was resistance can retain its importance for a while. This is what we call market memory. All right, so let's go take a look at gold under a different time frame. Here is gold going back just over 3 years, back to late 2019. And we can see a level that was resistance. Oh, sorry, I'm just trying to get this darn pen up. All right, a level that was resistance here became resistance here, fully 2 years later. And it got pretty close here too. A level that was support here remained support over here. Here we got support becoming resistance before we broke through. So again, psychology. Why would a level that was a peak become a peak again? Well, there are people who bought up here who regretted doing so when the market fell apart. They tell themselves, if it gets back up to my level, I'm going to get out at break even. So one of the reasons why we have a peak at a former peak is because of seller's remorse. Here we have a 5-day chart. So this goes back 5 days. And we could see some of the same principles playing out that we just saw on the longer term charts. We got a level that was, boy, I'm not very good with this pen today. A level that was support converted into resistance. We got a level that was resistance, or level that was support converted into resistance, a level that was resistance converted into support. So this is what I mean by the fractal nature. We see the same type of things on different charts of different time frames, and it's because what we're looking at is human psychology, and we're looking at various time periods that humans would be. So in other words, this is like a short-term swing trader type thing, 5-day chart. And so swing traders trade, and they usually hold positions for a few days or a few weeks. But, the swing traders who bought here, who regret doing so after the price went lower, a few days later go to sell and get out at break even. Same thing here. People who sell, a few days later go to buy it back to get out. We got market memory, resistance here was resistance here, support here, support here. So it's the fractal nature. This could be a 5-year chart. It could be a 5-day chart. It could be a 1-year chart. It could be a 1-day chart. It could be anything. And we're going to see these same principles because we're looking at human psychology of investors that have different time horizons. Now here is gold, and this is a 1-day chart. And once again, we can see some of these same dynamics playing out. Resistance back here, and this was like 3 in the morning or 6 in the morning because gold is a commodity, so it trades around the clock. But anyway, resistance back here became support over here. Resistance here became support here. Same principles. Now this is because we have short-term traders or day traders who sell, and when the price went up, they got upset. They said they want to buy their gold back, but only if they can get it at the price they sold it at. So if we have enough remorseful sellers placing their buy orders, the level that was resistance can become support. Levels that were support can retain their importance for a while. Right? So support, 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 resistance, support. Same principles. Some price levels are more important than others in the market. These are our support and resistance levels. These levels can retain their importance for a long time. And as we've seen, they can even convert back and forth from support to resistance and from resistance to support. And here we have a 8-year chart of gold. And once again, we could see some of the same stuff here. We have resistance in 2016, resistance in late 2017, resistance in early 2018. Here we have what we could call a ascending triangle. I'm sorry, ascending triangle. And this tells us that as time goes by, the sellers are kind of content to stay here. But the buyers are getting more and more antsy, and they're getting more eager to buy it. So when we have what we call a higher low, it tells us that the investors who are buying are getting more aggressive. So anytime you have a market, regardless of the market, if you have complacent sellers and aggressive buyers, it sets the stage for the price to move higher. We can see up here, support was in, support here, about a 2-year time period. Resistance here, resistance here, resistance here. So we see these same things on pretty much every chart. Sometimes they're more clear than others, but as you can see, we have these charts have this fractal nature, and we see these graphical illustrations of investor psychology playing out on a chart. So when you look at a chart, you got to understand you're not looking at tea leaves here or astrology. You're looking, if you're doing it correctly, you're looking at human psychology as illustrated by the price action. All right, so that's it, everybody. Please make sure you sign up for our YouTube page here and check out our website, stockmarketjobber.com. And thank you. I hope to see you soon.